Welcome to everyone coming into our webinar now. We'll just give it a minute and wait for everyone to join, and then we'll get started. While we're waiting for everyone to join the webinar today, feel free to jump into the chat box. It'll be at the bottom of your screen, and let us know where you're joining us from. We'd love to know. Looks like we've got a good representation from all of the states here today. That's great. Thank you so much for joining in. I will introduce, I've got Andrew from our customer support team here on the webinar with us today as well. And he'll be helping us to just moderate the chat as we go, kind of helping to answer any questions as we go as well. There will be time where I'll be answering a Q&A at the end. So throughout the webinar, feel free to jump in the chat for any kind of general chat, but if you've got specific questions, please use the Q&A button, which you'll find at the bottom of your screen. That way we'll be able to see specific questions to answer at the end of the webinar. Hi everyone, sorry about that. I just had a slight technical issue there, but we're ready to get started. So I'll just share my screen. Bear with me for a moment. All right. So before I jump into the content today, I just need to go through our little disclaimer here. So Superhero does not provide financial advice that considers your personal objectives, financial situation, or particular needs. And all investments carry a risk, so please make sure you consider carefully before investing. Past performance is not indicative of future performance, and any pictures, graphics, charts, or graphs are provided for illustrative purposes only. So today we're talking all about investment strategies. First of all, what is an investing strategy, you might ask? So an investing strategy is essentially a set of principles that guide your investment decisions. And there are a number of different investment strategies that you might choose to use. Investment strategies may also change over time, depending on market conditions, new trends that might arise, and as your personal situation or goals change. And just a reminder that as we go through these strategies today, it's not saying that any strategy is better or worse than another one, or that you should use a particular strategy, but it's purely to just understand some of the different types of strategies that people might use or do use in the market to make those investment decisions. And before you decide to invest in a certain strategy, it's important to understand your own financial situation, your time horizon for investing, and how much time you have to do that research and to review your investments as well, and how much time you want to actually spend making those investment decisions. Now, on the right of the screen, you'll see a little graph there, which I thought was just helpful. It shows essentially the risk and return graph. And again, there's it's much more complex than this in the market, but generally you can see that there's lots of different types of assets you can invest in, and each of these have a different level of risk and then potential for return as well. And what we're going to be focusing on today is really around shares. So kind of at the higher end generally of that risk curve, but then obviously there's a number of strategies within investing in shares that you can look at as well, that have their own different risk and return kind of graphs or views as well. Okay, so when it comes to those investing strategies, I've broken it out here into 3 different kind of buckets or types of investing strategies. The first one is an outcome strategy. So outcome strategies are based around an investing goal. So for example, selling for a profit or getting regular income through dividends. And some examples there that you might hear pretty often are growth investing or income investing or dividend investing. The second type of a strategy is evaluation strategies. So these strategies are used by investors to determine whether they want to invest in a particular company. So as opposed to more of a general outcome, these strategies are more around how you value a company or how you research and decide that you want to invest in a certain company. And you'll often see different valuation ratings or recommendations that are published by professional investors as well, based on a certain valuation strategy that they use to determine whether something, you often see kind of a buy or sell recommendation. So that's based on a certain valuation strategy. So an example of strategies that use valuations would be value investing or fundamental analysis. And then the third type of investing strategy is a behavioral strategy. And this type of strategy is kind of focused around the different timings of investments or frequency at which you invest. So it's less about the specific investment and more about the behavior around when you invest. And it could be used to maximize outcomes, to minimize the impact of volatility, or just to manage your own investing as well. So examples of this would be dollar cost averaging, long-term investing, or passive or index investing. Now, you may use all of these strategies in one go. So these definitely aren't mutually exclusive, but they just are kind of broken up into the different types for you there. All right, so what I'm going to do now is go into in a little bit more depth some of those strategies I just mentioned. So the first one is growth versus income investing, or growth or income investing. Now, growth investing is essentially looking at shares that are focused on growth, with the primary goal being the share price going up and selling that stock for a profit. So often, and this is not, and we'll go through some examples later that show you that this is a stock may not just be a growth stock and may not just be an income stock. It may be both. But generally with a typical growth stock, a lot of their earnings will actually be reinvested into the company to grow that company. So they may not pay a dividend. If you look at some of the kind of high growth stocks, startups that have happened over the past couple of years, you'll see that they often reinvest any money or any profits that they make back into growing the business. So they may not pay you that dividend or regular income, but there may be a higher chance that they will grow, therefore their share price will grow, and you can sell that stock for a profit. But keep in mind, obviously, that with high growth companies, they are on the riskier end of the spectrum. They've probably not been around for as long. And so the share price may be more volatile and the risk of company failure is higher than with income stocks, which are typically in more mature industries, have often been around for a really long time. So look, an example of a growth stock, you could think about Afterpay, you could think about Tesla, kind of these typical stocks that people would think of as growth stocks, versus what we come into in income stocks. So income stocks, like I said, they'll often pay a dividend or regular income, and that's paid out of their profits. So a percentage of profits they'll allocate to pay out to shareholders as a dividend. So as part of owning part of that company, you then get a share in those profits. So these companies are often large companies in mature industries that have very consistent levels of revenue, but less percentage growth year over year. So you may not see that, I guess, rapid share price movement and rapid growth, but they're often not going away anytime soon. They can also grow and deliver share price profits, but usually fluctuate less than growth shares. So an example of this might be the big banks in Australia. So Commonwealth Bank, Macquarie Bank, these companies have been around for a really, really long time, or a Woolworths or a Coles. They've been around for a long time. They've got a large share of the market, and they're making good profits. So they pay out a percentage of that to their shareholders. Okay, moving on to value investing. So value investing was that kind of valuation strategy I spoke about. And it's a strategy that has been made famous by the most well-known investor in the world, Warren Buffett. I'm sure you've all heard of Warren Buffett. And value investing is a long-term strategy that involves picking stocks that appear to be trading for less than their intrinsic value. So value investors are looking for stocks that they think the market is underestimating. So they think that the company really should be valued at more than what the current share price is. To put it back to an example that's out of the investing world, they're looking for stocks on a discount. I love a good discount shop. So when I see something that's 20% off, 30% off what the normal retail value would be, definitely makes me want to buy that dress. So if you think about it in that way, it's looking for stocks that are trading under what the investor deems, and again, that what the investor deems to be the underlying value of the stock. There's a range of different strategies that people will use to get there, but they believe that it is currently undervalued. And you can see in the graph on the right there that they're looking for those kind of prices in the market where they see an opportunity to buy in. So the belief here that underlies value investing as well is that the market often overreacts to both good and bad news. So if a company has, a certain announcement and the stock price goes down or up, they believe that this often happens at a larger rate than what is truly the underlying impact or value. And so they see those opportunities in the market after certain announcements or big movements to actually make the most of that opportunity. Okay, so when it comes to analyzing a company's value, there are a number of different metrics that an investor may look at. And it will be a combination of these. They may focus on one more than the other, but here are some common metrics that investors often use to analyze company value. The first one here is the price to earnings ratio, or the PE ratio. Now, the price to earnings ratio is a ratio for valuing a company that measures its current share price relative to its earnings per share. So it's essentially saying how expensive or cheap is the stock price compared to the profits the company is actually making. So for a company that is more of an income or a mature company, you'll often see a lower PE ratio because they're having kind of those high profits compared to their share price. For a growth company, you'll often see a higher PE ratio, which means that their share price can be seen as a bit more expensive for the profits that they're making today. But obviously, like we spoke about, there is an expectation that those profits will grow significantly in the future. So an investor may look at a growth versus a mature stock quite differently when they're measuring the value of that PE ratio and the PE ratio that they're looking for in order to determine whether it's a good investment for them or not. The second term on this list is the price to book ratio. So the price to book ratio measures whether a stock is over or undervalued by comparing the net value of the company, so assets minus liabilities of a company, to its market cap. So as opposed to looking at the company's 1 year profits, for example, this is looking at the entire value of the company or the company's assets or net assets compared to its market capitalization or its market valuation. All right, the third one is the debt to equity ratio. So the debt to equity ratio helps investors determine how a company finances its assets. So it shows the proportion of equity to debt a company is using to actually finance its assets or its growth. Again, feel free to jump on to Google. There are some great resources here that will go into each of these in a little bit more detail. But this is just a bit of an overview if you're looking for certain terms that you might see investors use. Free cash flow. Free cash flow is the cash produced by a company through its operations minus the cost of expenses. So it's what's the cash left over from a company doing its business and making its revenue once it's taken all of its expenses out. And cash flow is often an important metric used, I guess, to determine that a company has enough cash to keep its operations running, to invest in research and development, and to grow as well. So it can be quite an important metric when looking at a company's viability in the long term too. And then the last one here is the price to earnings growth ratio. So similar to the first price to earnings ratio, but this one's looking more at the growth year on year of the company's revenue as opposed to just the revenue or the profits itself. So it's actually looking at that ratio of growth. All right, let's have a look at a couple of company examples. So we've got two Australian listed companies here. So I'm sure you would have heard of both of these. We've got Lovisa, which is a jewelry retailer and online as well. And then we've got Fortescue Metals Group, which is kind of one of the biggest mining companies in Australia. So I thought it would be good just to have a look at the differences and similarities between two of these companies. Firstly, we can see the market capitalization. So Fortescue is a lot bigger than Lovisa and was also founded quite a bit earlier than Lovisa. So founded in 2003, been around for just under 20 years, whereas Lovisa is just over 10 years old. So hasn't been around nearly as long as Fortescue. Again, you can see very comparative to market capitalization. The revenue of Fortescue is much bigger than Lovisa at the moment. So Lovisa is just a smaller company than Fortescue is. But when we look at revenue growth, you can see that there's quite a big difference here. So Fortescue, again, it's a mining company. Mining companies are obviously dependent on a lot of factors, not only within the company itself, but also macroeconomically, when we think about what's going on in terms of export and trade, prices of certain commodities. They're affected by a lot in the market, as is Lovisa in terms of they're actually looking to internationally expand as well. So again, it's important to not only look at a company's numbers, but also look at the industry that company is in, look at other companies within that industry and how they're performing as well. Because there are what we call micro factors or factors that are within the company's control more so. But there are also these macro trends around how the market is generally performing and locally and globally that may affect how a company is performing in the short term as well. So it's always important to look at that too. So we can see here that Lovisa's grown its revenue very significantly in the past year, and that is largely due to its international expansion. So it's looking forward to looking at new markets. And a great way to understand what's going on inside a company as well is if you jump into your Superhero app, there's actually a news tab that you can see any stock that you're holding or following, or if you're just searching a stock as well, there'll be a little news tab when you go into the stock, and it will show you the company's most recent announcement. So that might be a certain investor presentation that they've done, which might explain kind of what you're seeing in the overall numbers. So for example, whether the company is looking to expand or launch a new product. You can see here that both of these companies are profitable, which is great. And both of these have had, over the last 5 years, have had really strong share price growth over those 5 years. Again, there may have been years that are better than others in those 5 years, but over 5 years, they've both grown. Now, we spoke about growth and income stocks. Both of these shares actually, or companies, also paid out a dividend in FY22. You can see that Fortescue's percentage was a lot higher this year than Lovisa's, but both did pay a dividend. Again, when it comes to dividends, they are not stable. So just because a company's paid out a dividend 1 year or paid out a certain dividend, it doesn't mean they're going to pay out any dividend the next year or that it will be the same. It really does depend on the performance year to year. So again, don't only look at 1 year when you're looking at a company's performance, but look at historical data and also look at what's happening in the market generally and future trends as well. And you can see the PE ratios there again, like we spoke about. For these more mature companies, it's more common that you'll have a lower price to earnings ratio versus a company that is really still in that high growth phase. So Lovisa been around 10 years, but has really started to ramp up its growth recently. Okay, moving on now into what we called the behavioral investing strategies. Firstly, we've got dollar cost averaging. So dollar cost averaging is an investment strategy where an investor divides up a total amount to be invested in a share across a number of periodic investments. So say, for example, instead of investing $10,000 into a share all at one time and trying to pick, and you can, if we follow along the graph on the right there, instead of trying to pick the lowest point in that time in order to put your money in and try and get the biggest return, what some investors choose to do is actually split up that investment over a number of different time periods. So for example, if we're talking about a $10,000 total investment, they may choose to invest $1,000 a week over the next 10 weeks. And we know that no one can time the market. Not even the best investors in the world time the market all the time. So this is a strategy to essentially just put in money. You might decide that you want to invest every Monday, for example, over the next 10 weeks. And you'll just put in money consistently. And the aim of this strategy is to reduce the impact of overall volatility on the purchase. So to invest in, keep investing in, you'll hit those different points in the markets inadvertently, and then look to, I guess, grow your investment over the long term. I can see a couple of questions coming through in the chat. If you just want to pop those in the Q&A function, that'd be really helpful so we can keep track of them and make sure we don't lose them, where we'll have some time for live Q&A at the end. Okay, the next strategy is long-term consistent investing. So long-term investing is a strategy to invest according to, I guess, a set budget or goal, and this may change over time, but to have a goal and a budget and invest consistently over time. Now, we know, and this year's a perfect example, and definitely the past couple of years, is that the stock market doesn't always have a great year, but then other times it may have a great year. So as seen by 2020 to 2022, markets in the short term can be very volatile. The benefit of investing in the long term is that over the long term, with the power of compounding, your earnings will compound. And so what that means is, if we think about a 10% gain on $1,000, that gain would be $1,000, giving you $11,000 at the end of a year, for example. Now, after the end of year one, you would have $11,000. And if that went up by 10%, you'd actually gain 1,100. So same percentage gain, but the actual amount that you gain has increased. And so that's what we call compounding. And a great tool to be able to understand how compounding works is the Money Smart calculator. So if you type into Google Money Smart, I think it's called the compound interest calculator, you'll be able to go in there and have a look at different budgets and time horizons, and see how that works essentially over the long term. And the graph on the right is an example of using that graph. And that shows a $100 monthly investment over 20 years. And we've popped in there an average return of 9.7%, which you'll see why we did that in a moment. But just shows, again, your graph won't look like this because the markets do go up and down in different years. It's not a steady linear curve. But what we're talking about here is the average over the long term. And you can see there the power of compounding. So the dark blue being the amount of money you put in over time, and the light blue being the amount that you gain or earn, or what's generated by you having your money in investments instead of your money, let's say, in cash. But again, keep in mind, there are risks when you invest. So, you could go and put your money in a high interest savings account and you might get an average of 2% per year versus investing. So again, really important to look at what your own goals and risk tolerance is around investing. And why we chose that number, this graph just shows you that stock market in the last 30 years, I think it is. Yeah, 30 years. So you can see here that the market very much goes up and down, sometimes a little bit, sometimes a lot. And it has depended really on these big macroeconomic things that have happened. So you can see there's been kind of around the 2000 time with the dot-com bubble burst. We saw a bit of a big drop and then a big gain again. The global financial crisis around 2008, the same thing happened. And then in 2020, we obviously saw with COVID, the markets kind of dropping quite quickly and then regaining. And then in 2022, we've seen a bit of a drop off again. So again, the markets are affected by many, many things, but you can see there Australian shares have gained an average of 9.7% per annum or per year over the last 30 years. And you can see there how that compares to different asset classes. So we've got US shares there, which have been slightly higher on average. We've got listed property. So that is the likes of real estate investment trusts that are actually available for investment on the ASX as well. And you can see international shares more generally, bonds, and then you can compare that to the cash rate as well. So just to compare that to, let's say, having your money in cash. And yeah, already gone through this, so I won't spend too much time on it, but just shows you the number there. Okay, we've gone through a lot of different strategies now, but this is a graph I love to use because it really shows you the difference between different types of strategies, and these are on the behavioral strategy side, that people might try and use and how that will affect their investment, or how this, again, this is just an example, but how it might affect your investment over the long term. So this is based on using $12,000 a year of investment over 10 years using different approaches. So this was done, or this example was based on between 2010 and 2019. And it was based on a diversified portfolio. So again, it very much depends on how you split your investments, but this was based in a diversified portfolio with 70% growth and 30% defensive assets. So you might think of it as a diversified ETF, for example. So in scenario one, the investor got perfect timing. So they happened to invest at the low point each year in the market, which resulted in the highest return. So obviously we'd all love to think that we could get perfect timing in the market, but essentially impossible. But if you happen to do that, you would have had $189,885 at the end of 12 years after investing $12,000 for 10 years. Now, the second strategy was if someone decided to put that $12,000 in on the 1st of January each year. So they didn't try and find the perfect time in the market. They just invested on the 1st of January each year. Now you can see that this strategy got slightly lower returns, but still pretty decent returns, and had $184,055 at the end of 12 years. The third strategy was dollar cost averaging. So what we spoke about, which in this strategy, they invested $1,000 on the first day of every month over those 12 years. So $12,000 a year over 12 years. And this strategy got the investor $177,000 and $288. The fourth scenario is perfectly wrong timing. So this is if the investor put their $12,000 in at the high point in the market each year, or wrong timing compared to perfect timing at the start, which was the lowest point each year. Look, despite bad timing, they still came out with $167,000. And then we've got scenario 5, which is if you just held your money in cash, you would have had $133,000 at the end. So you can see there, and again, this isn't prescriptive by any means, but having your money in the market historically has proven to be better than cash, even if you invested at the high point of the market each year or had perfectly wrong timing. So it's important to know that if you're investing for the long term, some of those kind of more volatile ups and downs that you may see day to day, it's important not to let that, I guess, stress you out too much. Again, depends on your risk tolerance and how you are investing. But what they always say, or a common investing term, is time in the market beats timing the market. So looking at that long-term view. All right, and when it comes to long-term and market investing, it would be amiss of me not to mention diversification. So again, investing in shares or any other asset that's not fixed does carry some risk. And so diversification is a strategy used to reduce risk by allocating investments across different types of asset classes, industry sectors, and companies. So it's not putting all your eggs in one basket. It balances out your investments, and it's a defense against a single investment performing poorly. So your total return isn't based on the performance of only one company in one industry, but it's spreading your investments out across a number of industries and a number of companies to make sure that you're not solely dependent on one company. And ETF investing is a common way that people may decide to diversify their investments, because you're able to invest in one investment on the stock exchange, or buy into one investment, and it will give you that exposure to multiple companies in one go, as opposed to buying 10 different companies in different industries yourself, which you can do. This is a way that you can just buy into a certain index or basket of companies, and it can do that diversification for you. So ETFs, a unit in an ETF represents a basket of multiple companies. So for example, the top 200 Australian companies or the top 100 US tech companies, they help you diversify your portfolio, as we said. And there's different themes of ETFs as well. So you might decide to invest in an ETF. An ETF, stands for exchange traded funds, if anyone doesn't know that. And it just means that it is an investment fund that you can buy and sell on the exchange, or on a share trading platform, for example, like Superhero. And you can buy ETFs that track the entire market. So the Australian market or the US market, which would just have kind of the top or the biggest companies in that market. Or you might choose to pick a certain theme. So there are ETFs that might focus on healthcare, or ETFs that might focus on battery technology. So if you're passionate about a particular sector, or you want to buy into an entire sector instead of one company in a sector, you can also do that as well. So you've kind of got a total market type of investment, a sector type of investment, or individual companies that you can invest in, to kind of break it down by size that way. And investing with Superhero. So I just wanted to go over, there may be some people on the webinar today that don't have a Superhero account or haven't invested with us before. Just a reminder of, I guess, how our platform works and some of the features that we have. So you can invest in Australian and US shares and ETFs on our platform, also real estate investment trusts and listed investment companies as well. And we've got a lot of investments available. So I think there's around 8,000 on the platform today. That may seem overwhelming, but we've got a really awesome invest tab as well, which you can go into, and it will kind of categorize some of those investments for you, so that you're not overwhelmed when you first come onto the platform. And in terms of pricing, we have $0 brokerage to buy into Australian listed exchange traded funds or ETFs, $5 brokerage on all other Aussie share trades, and $0 brokerage to trade US shares as well. We've got real-time deposits, so you can use your Pay ID if you've got one to go from your bank into Superhero, or you can use a BSB and account number. In your wallet, you'll see all of your unique kind of payment options as well, and you can do that. When it comes to trading US shares, you will need to transfer between Australian dollars and US dollars before you make that US investment. There's a small fee to do that, but it's all in real time. And once you kind of convert that money from Australian into US dollars, you're able to trade US shares with no brokerage. So it's just that currency transfer fee that you pay when you go between Australian and US dollars. If you've got any more questions on any of the features or fees that we have as well, please feel free to contact our team on live chat. So if you just go onto the Superhero website, you'll see a little live chat button in the bottom right-hand screen, and they'll be able to answer all of your questions when it comes to fees or how to place a trade or anything like that. So the guys are on right now, and they'll be on after the webinar and all day if you have those specific questions. Some other quick features to mention are that we've got live market data, so you can always see what the share price is. tax reporting or portfolio reporting as well. We've got a range of different reports available, everything from what transactions you've made to your gains, both realized or unrealized as well. So definitely check that out in the reports tab. If you're on your mobile app, that'll be under your profile under reports. You'll be able to download reports as you go for different time periods as well. And you can earn Qantas points with Superhero. So again, for full details on the Qantas partnership that we have, it's superhero.com.au/Qantas, and you can go and see all of the offers we have available at the time. Also, feel free to contact live chat for more information on the Qantas offer. And if you've got shares sitting with a different investing platform, you can transfer those over as well. And again, available information on our website, or feel free to contact live chat on that as well. And very quickly for a visual, this is how you can invest with Superhero. So you can sign up, deposit with PayID, that's instant deposits as well. You can go to the Invest dashboard and have a look around and choose an investment to buy. So just to show you very quickly. All right, I'm going to stop sharing my screen and let's get into a few questions. I hope that was helpful for everyone. And if I don't get to any of your questions live today, we'll make sure this webinar will be up on YouTube within the next couple of days, so you can watch it back and pause the content if you want to have a look at a particular slide in more detail. Okay. All right. Just getting this up. Okay, so a couple of questions on dividends and how those work. So if you get a dividend from a share in your Superhero account, that will come into your wallet as cash. Now, there's a feature that I know people do ask for, which is called dividend reinvestment. It's on the list, and we've heard you. So don't worry about that. But at the moment, it will come to you as cash, and you can use that to either withdraw, or you can use that to invest again. So it will come into your wallet as cash. But we know that automatic reinvestment is asked for. Okay, how do you withdraw? Okay, so an important one to note, actually, in order to withdraw funds from your Superhero account, you do need to have deposited with that same bank account. And that's for security purposes. So you need to make sure that you've deposited from the account you wish to withdraw to. And that's to make sure that we know that it's your account that you're withdrawing to. So I hope that makes sense. And it normally takes, depending on your bank, depends which bank you're with, but it can take 1 to 2 business days, just depending on the bank, or it may take less than that. Wish I could tell you exactly when it's going to arrive, but it does depend on the banking system as to when you get that withdrawal. But you'll get either a text or a push notification to tell you that we've received your request and your withdrawal's on the way. Okay, question on SMSF accounts. And this is a great question as to the different types of accounts we've got with Superhero. So we've got in our trading platform, we've got 3 different types of accounts. The first one is an individual account, which everyone will have when they first sign up for Superhero. The second type of account is a minor account, which is if you've got children under the age of 18 and you want to set up an account on their behalf, you can actually go and do that from your profile. You can add a new account, and you could have, if you had 3 kids and you wanted to set that up, you could set up 3 minor accounts, for example. Now, keep in mind that you will still be the legal owner of those shares. You have to be until that child turns 18, and then you can choose to transfer those over. But it does allow you to, I guess, hold certain investments in a specific account for that child if you'd like to do that. It's quite a popular feature of ours. And then the third type of account is a company account, which includes trusts and SMSFs, or self-managed super funds, with a corporate trustee. So if you're in that category, you can go and add that account from your profile. And it's the same investment menu across all of those 3 accounts with Superhero. So you can trade Australian and US shares, ETFs, individual US shares if you want, like Tesla, and it's the same way to transfer between Australian and US dollars. That happens in real time as well. So that transfer between Australian and US dollars is in real time. So for example, if you wanted to buy Tesla shares, you could log into your Superhero account, you'd make a deposit, you could make that in real time with PayID, you could transfer that from Aussie to US dollars in real time, and then place a trade with Tesla. Now, again, depending on whether the market's open or not, you could still place that trade, and then when the market's open, if you've placed a market order, that will execute for you. So yeah, pretty flexible there around what you can do, and the entire investment menu is available for all different types of accounts. Question there around family trusts. Depends on your trustee. So if you've got an individual or joint trustee, they're not available at the moment, but we know that people want that. But if you've got a corporate trustee, so a company as your trustee, you can open that account today. All right. Question there from Vested Shares in the chat around ESP shares. Contact live chat on that one. I think that's Ranveer. Apologies if I said that wrong. Contact our live chat team and they'll be able to support you on that one. It's a bit more of a specific one there. Just having a look through. Does Superhero have company metrics to look at value? Yeah, so if you log into Superhero and you search a specific stock, it'll provide you with a range of different information about that stock. Again, depending on exactly what metrics you're looking for, you may need to find other sources, but we've got a lot of general metrics on there. So just log in, have a look, and you'll be able to see things like PE ratio available on the platform. And like I said, there's that news tab, which you'll see all of the company announcements for ASX companies as well. US, unfortunately, they don't report their announcements the same way. So a little bit different on that one. But for all ASX stocks, you'll be able to see any company announcements, because companies in Australia that are listed on the ASX, they have to kind of publish announcements, which we then pull through for you guys. Okay. I think we're nearly coming to the end. Just having a look. What's the best way to find out if a company pays dividends prior to investing? Sure, great question. So when it comes to dividends, again, you can only see historical dividends, but that information is really readily available online. So you can definitely look up what the dividend has been in the past, and Superhero also has that information. When you search the stock, you'll be able to see kind of a historical dividend number there as well. And how do you find historical data? So when it comes to a share price, you can see all of that on Superhero. If you're wanting to look at kind of past financial metrics and things like that, there are a range of resources. If you just Google online, you'll be able to see that as well. Just seeing if there's any other ones there. Just having a look through. Sorry, guys, there's a lot of questions coming through. So any that we don't get to, we'll aim to email you after the webinar as well. Where to get tax reports? Question from David. So David, to get tax reports, you can either do that on the desktop app for Superhero. You'll be able to see a reports tab right there when you first log in. If you're on your mobile app, that'll be under the profile. Now, you can go in and you can download those reports and you can select which time frame, and one of those will be the previous financial year. So again, contact your accountant or person that you deal with for tax. But yeah, that's where all of those reports are, and hopefully they'll be able to tell you which exact ones you need for your tax. All right. Question on US trading. If I sell shares and transfer money back from the US, how much is that? Yeah, so the transfer fee for US shares, like I said, we don't charge any brokerage when you trade, but instead of that fee, there's a fee when you transfer in and out of Australian and US dollars. So it's on our website, but it's 0.7% is that fee. But you'll see the exact fee when you go into your wallet and you go to the transfer tab, which is where you can transfer between Australian and US dollars. When you put in how much you'd like to transfer, either way, you'll see exactly what that fee is going to be. So that's a really good tool. And you can even go in and calculate that before you can confirm to see what that fee will be. If you're unsure, feel free to jump in and you'll be able to see what that is and calculate that in order to transfer between. How long does a good till cancel order last? Yeah, so that's a question from Yi. Now, when it comes to placing a trade on Superhero, you've got now 3 different types of orders, which is a good one to mention. So the first one is a market order, which means that you're happy to trade at whatever the market price is. So that trade will go in for you whenever the market's open, and it will trade at whatever the market price is. So you select the amount you want to invest, let's say that's $100, and then it will be placed into the market and get the market price for you. The second type of order is a limit order. And this is where you specify a certain price at which you want to buy that share. So for example, if there was a share that was $10 a share and you only wanted to buy it if it hit $9 a share, so you wanted to wait and see if it came down, you could put in a limit order for that stock at $9 per share. And that will sit in your pending orders and it will sit there for 30 days. Now, if at any point the stock hits that price, it will go into the market for you. But if it never hits that price, it will expire after 30 days. So that's how long, I guess, a limit order lasts if it doesn't complete or execute, or if the share doesn't hit that price. Now, you can go in and cancel that order at any time if you want to, if it's still sitting in pending, and you'll receive a message if that order expires so that you can go in and set up another one if you want to, but it lasts for 30 days. Okay, question, sorry, before I go into the next question, we've got a new order type, which I'll just run through very quickly. It's called recurring orders. And this is where you can set up kind of an automated investment into a certain stock. You'll still have to have enough money in your wallet at the time. But for example, you could set up $100 or $200 into a specific stock once a month or once a week. So yeah, you can go in and set up that recurring order if you're wanting to invest consistently. Kind of, if we think about that dollar cost averaging strategy, for example, you could automate that. And yeah, you could also set up recurring deposits from your bank to make sure that you've got money in there when your recurring deposit goes in as well. Question here around a number of features, options trading, European shares. Yeah, we've got a long list. So thank you for all of your suggestions. We'll definitely take those. We're going to make sure we collate all those and send those back to our team as well. I think we'll leave it there today. If anyone has questions that weren't answered today, feel free to contact live chat. And we'll also make sure we get all the questions that were asked today and get back to you on email as well. But thank you very much for joining. I hope that was really useful for everyone. And also important to mention, keep an eye out both on YouTube for the recording of this webinar, but also we've got a really exciting series coming up called Sector Spotlight over the next couple of months, which will take a deep dive into a range of different sectors, both in Australia and the US. So yeah, keep an eye out for that one. It'll be coming soon. Make sure you're looking out for your emails and push notifications from Superhero, and have a lovely rest of your day. Thank you.